Thanks for joining us today for our weekly investment brief that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So, starting with our chart of the week, let's focus on the left side here. It's showing the net worth growth for the top 20% of earners and the growth for the bottom 80% of earners. Note that the top earners have benefited from asset price appreciation that the bottom 80% just don't have as much exposure to. Now, that trend is contributing to the so-called K-shaped economy, where the very top end is seeing more growth in their spending power than the lower income cohorts. Now, last week's personal income and outlays report showed us that personal incomes, especially after adjusting for inflation, continued to slow. Income grew a pretty paltry 1% in the 12 months that ended in February. Now, spending has held up a little bit better, but spending has also slowed from its peak. Now, consumers were already dealing with some building inflation pressure prior to the conflict with Iran. PCE was reported for February, and that was before the conflict began, and it did come in on the hot side. The primary driver was a 2.3% increase in goods prices, and that's likely owing to tariff pass-through. Note that before 2021, goods prices often contracted, helping to offset any service inflation that we were getting. Now, given the trends in income and inflation, it's perhaps no surprise that consumer sentiment has been souring. The assessment here from consumers of both their current situation and expectations are both at cycle lows. Now, separating out the challenge that consumers face from the market impact, consumer inflation did bump up to 3.3% for March, owing really to higher energy costs. But that's not enough of a jump to create a meaningful headwind to the stock market. Inflation would have to climb to the high threes or even 4% before we'd expect it to be a drag on stock performance. Now, part of the reason that stocks can weather an inflation impulse is because earnings are a nominal variable. They're not adjusted for inflation. So, in other words, as inflation rises, earnings also tend to rise. Forward earnings have continued to climb, and the stock market has tracked that change in earnings estimates. Now, Q1 earnings season kicks off this week, and consensus estimates are for about 12% earnings growth in Q1. And that's good news for investors as the stock market tends to avoid major bear markets when earnings are growing. Now, another positive trend has been that the performance of the transportation stocks has been solid. We can see here in this chart that the transports are trading at a cyclical high, and that confirms strength in the broad Dow Jones Industrial Average. Transportation is economically sensitive, so this trend has been encouraging. Now, we've been discussing the oversold and pessimistic conditions and noted that a near-term relief rally was likely, and last week delivered on that. Now, year to date, the S&P 500 is approximately unchanged, while small caps, international markets, and commodities have all been strong. But some of our favorite technical indicators remain somewhat uninspiring. This one measures the percentage of stocks above their respective 10-day average price. Readings above 90% have been a good guide that the correction is over and the bull market is resuming. We're not there yet. Now, our base case is that volatility is likely to persist through the summer. The blue line in this chart here shows price action for the average midterm election year. Note that the bottom tends to be carved out after the summer before a strong year-end rally has launched. So pulling it all together, the dispersion between the top 20% and everyone else is contributing to a K-shaped expansion. The lower income cohorts are struggling with persistent inflation and weak income growth. But earnings season kicks off this week, and estimates have continued to climb. And that's good news for stock investors, as is the performance of transportation stocks. We think that volatility will be with us through the summer, but as long as earnings continue to grow, the bull market is likely to reassert itself. So that's what we have for you this week. And as always, I want to wish you a great week ahead.